So my name is Gershon Margolis. I am the founder of Imperial Advisory. We are a fractional CFO firm, um, and we work with CEOs, sometimes CFOs, and help them make better, more informed business decisions. Um, I generally say we pick up where accounting leaves off, and we help people understand the past, live in the future, and then ultimately offload a lot of the financial work onto us so that they can get back to doing what they do best. One of the very important tools out there for helping people make smart business decisions is a budget. And that is the topic of today's webinar. Um, and that is what we're going to discuss. So I guess I'm the official speaker today. And like I said a moment ago, Steve will be speaking or participating along with me. So again, thank you to all of our teammates and guests and listeners and recording listeners. And let's get started. All right. So the first question is, and then like I said, Steve, Steve, you jump in. Um, and whenever you've got something to say. So the real question is, oh, here, I put on a couple of slides just introducing the firm a little bit. Um, Wait, there we go. Team. Here's a picture of our team. Steve's on the top over there. We got a whole bunch of other people. Um, First, I just figured I'll talk a teeny drop about how we view the role of the CFO, and then we'll jump into the budgeting. So the CFO, what we have over here on the screen is basically the finance and accounting, as well as the CEO and how the CFO fits in. The basic idea is from the most basic to the most complex is you have data. The data needs to be turned into good information. The CFO helps with taking that and using it to create and support the vision of the CEO. And anyone interested in this slide, happy to share that after. The CFO gets involved in a variety of things. And again, today we're talking about budgeting. We got some testimonials from our team. Anyway, what is a budget? Let's get started. A budget is, and different people will probably have a different take on this, but a budget is the beginning or can be viewed as the beginning of really of a 5-year forecast. The budget is the plan. It's a plan that you put together to help envision what your business is, what your business should look like. It's a detailed document, often made in Excel, but there's a lot to it. It's really about, as we'll discuss today, there's a lot about the process, how you do it, how you go about doing it. It's more than just building an Excel model. And the truth is, in theory, you could probably even build a budget in not in Excel at all. You could probably build it in Word if that's your thing. But it's more about going through this process. Excel is certainly a very useful and powerful tool that helps. So anyway, what is a budget? Why is it important? So like we said, the budget is it's the roadmap. It's the roadmap to help you, you look at where is it that you want to be? Where do you want to be in 5 years? Where do you want to be in 1 year? And how are you going to get from here to there? And when we're dealing with a budget, one of the things that it's important to keep in mind is that it's not just a piece of paper that you write or Excel file that you make, leave and forget about it. It's something that really needs to involve different people in the company, as we'll discuss, and it also needs to involve different people in the company, and it also is like a living, breathing document, something that you use and continue to use as things change. Now, when we think about a budget, it's needs to be, well, you need to have, like we said, you have to have the other people on the team on board. And again, we'll talk more about that. But the first step really is, what's the plan? What are the expectations? Management needs to come into this process with high expectations. And by management, I mean the owners, the CEO, the C-suite. You come in and you say, here's where we want to go. And then it's about putting that plan together. And then we ultimately, as we'll discuss more later, you need the other teams within the company to help with taking ownership and execution. So management, senior management needs to push, but then the middle management needs to operate. And I know that there are some smaller businesses who are either here now or mentioned that they'll be listening to the recording. So I'll mention that a lot of what we'll talk about today, we'll talk about multiple layers. Not every business has all these layers, but when you're a business owner, even if you're running a one-person business, you have your job as the visionary, as the planner, and then you have your job as the doer. And going through these steps, right? You could be running a one-person business, and there's someone who mentioned to me that they're looking to have a business of 5 clients. The process is going to be the same. It's saying, if I want to have 5 clients that I'm going to manage, I'm also the head of sales. What's my sales plan? Right? There might not be a separate sales director, but what's the plan? How am I going to get those 5 clients? And if I'm out there looking for clients, how am I going to manage the other clients? And can I really do all that work myself? Et cetera, et cetera. And if not, what's the timeline in which I could do it? We're planning to bring other people in. Anyway,
let me just add to what
yeah,
Gershon said about having other people involved. So you really have to have buy-in from not only the C-suite people, because they'll buy in, but the people who are actually have to execute the budget. So you need your sales directors to really buy in on the revenue projection, because if you force them on a revenue number, and this happened to me in my career, particularly when we were owned by private equity, they wanted to see a growth number, which was way far north of anything we realized we could get to. So they would impose a number of about 10 to 15% revenue growth, and nobody bought in on it and nobody believed it. But so sure enough, after 3 months, we were running behind, and they said, "Oh, now we have to reforecast and do another budget because you're not hitting it." So you're not wasting everybody's time and putting numbers in that the owners want to see. It makes everybody feel good. But if nobody thinks they can execute on that budget, you're just wasting time. So you really need to get buy-in from your lower level people, people below the C-suite, all your directors, and come with a budget that everybody believes they can hit. That's the most important thing, rather than having being dictated from the C-suite. And then, like I said, nobody believes it and it never happens. And you just, like I said, you've wasted a lot of time putting numbers on paper that you're really realistically not going to hit.
thank you, Steve. And we'll discuss more later. That's a great point. But that concept really goes throughout the organization. It's not just the sales team. It's the sales team, it's the operations team, it's HR. Can they hire people fast enough, right? You might allocate dollars to pay salaries, but if HR says they can't bring those people on, then the people are not going to be there to do the work salespeople sell, even if the salespeople could sell. I mean, we had a client a while ago where they had a huge bottleneck in onboarding. They could sell, but they couldn't onboard clients fast enough. And that was a major, they just couldn't grow sales. And those were sales they were essentially losing. They were a software company. So it took them 4 months to onboard a client. That was 4 months that, 4 months of sales that just weren't happening. And so they, for them to raise their sales budget would have been a lot more than just dealing with the sales director. It's the sales director, and then it's, did they have enough people? Could they afford to pay the people they needed? That was actually one of their challenges, and that's part of why they were going out to raise money. But anyway, all right. So why is a budget important? So here are 4 reasons that we'll touch on briefly. 1, forecasting and planning, right? Obviously, as Steve was saying, you got to forecast revenue, and having the budget, quite often revenue, maybe all the time, revenue is the first thing that you're forecasting. But as we'll discuss later, what is it that causes revenue? And so, again, we'll talk more about that later, but revenue is not necessarily the first input, or not practically the first input. You might look at it and say, well, we want to reach this point of revenue, but how are you going to get there? But either way, budgeting will help with putting this plan together. So obviously we have to talk about revenue. We have to understand revenue. Revenue is part of the forecast. We'll talk more about it later. There's when forecasting and planning for your organization, there's expenses. You know, as small company, you know what's going on. You do everything on your own, but things can get out of hand, and you know you have marketing spending money, you've got IT spending money, you have all sorts of things going on. Part of the forecasting and planning and figuring out, does this all work, and how does this all work, and how does it all fit together? Part of that is and can be dealt with and controlled, etc., during the budgeting process. Obviously, cash flow. When you have a plan, and we were just talking about this on our team meeting prior to this webinar, right? We had a client who they could probably grow, but depending on what rate they grow, they may or may not end up with cash flow issues. We have a prospect we're talking to right now. They're growing rapidly. They're making a lot of money, but because of their receivables lag, they potentially run out of money at a certain point. So understanding what those things are is very important, and having forecasting planning is you can anticipate that, you can deal with it, maybe you get a line of credit, you figure out what you need. There's tax planning as well. If you know what's going to happen, you can make smart decisions. You make smart decisions on lots of things. Next, resource allocation. You only have a certain amount of resources. Many businesses are constrained by money. Other businesses are constrained by time. Whatever your bottleneck is, having an understanding and a plan of what you need and when you need it, by having the plan, you know when you're going to bump into those issues. And the tighter and more precise the plan, again, it doesn't necessarily have to be exact, and we'll talk more about that later, but by having the plan, you end up with a lot of things popping. You see, oh, if we grow like this, we're going to have a cash problem. If we grow like this, we're not going to have enough people to onboard, and therefore we're paying our salespeople commissions for selling what we can't deliver, or whatever the case may be. There's performance measurement, right? As Steve mentioned earlier, you got to get your team on board, and we're going to talk more about that, but you got to get your team on board. But once the team is on board, who's accountable and what are they accountable to? So if you've got the budget and you've got the plan, and you say, well, we're growing sales by $1 million, by $10 million, doubling sales. In order to double sales, well, the salespeople have to deliver, but in order to really double sales, the operations people have to deliver. In order for the operations people to deliver, maybe you need more people. So then that becomes something that HR is accountable for, or whoever it is that's responsible for getting the people. Next, you sometimes have financial issues, right? You want to be able to know, and we'll talk more later about what goes into a revenue forecast, but right, if you project revenue is going to be up 30% and revenue is not up 30%, why is revenue not up 30%? Is it because we have fewer clients? Is it because we're charging less to the clients? Is it because, well, maybe we're selling to the same clients, but we change the terms, we change how we look at it, maybe we're running on a cash basis and missing out on the fact that things should be accrued. So if you want to be able to measure and have things pop, you have to have something to measure them against. So the budget serves potentially as that initial template for here's what it is, here's what it should be, and then that's kind of something, it's a metric, something you can compare things to. And then we have risk management. So there are all sorts of things that happen in a business, and by going through this process, you potentially can uncover risks, right? If we have a revenue forecast, or we have an expense forecast, or whatever it is, what are the risks that can, kind of goes back to the bottlenecks, the risks. What are the things that are going to be required to make this all work? And identifying those things is really all part of this process. And often those things will come out through this process. Something else I'll just mention is shareholder and other stakeholder confidence that if you're dealing with investors, dealing with people on your team, and those people know that you have a plan and they trust that you have a plan and that you're going to keep to your plan or you're going to monitor your plan or that there's a plan for the growth rather than let's just make more money, you potentially gain a lot of confidence in the people you're dealing with. Let's stop for a minute and see if we have any questions, and then we will move on. Or Steve, you have anything to add at this point?
Yeah, on the performance measurement. So once you do have a budget that everybody buys in, you could design comp plans now based upon the budget and what everybody agreed to the performance should be. So if you want to, compensate people how they hit compared to their budget, their sales or profit, you could do that now that everybody's bought in on it, as opposed. So everybody's now going in the same direction. They hit the budget, and it's a great way to compensate people based upon how they do versus budget, whether they're in sales, operations, whatever metrics you decide. But what we found in any plan, the bottom line profit should be part of the component, because you don't want to be paying out money when if somebody does hit plan, but there's no profit. So you really have to weigh, profit versus, other metrics and design a plan, but usually based upon what the forecast and what the budget is.
Thank you. Steve, I'm curious, what happens if a team does everything they're supposed to do and then the company's not profitable?
So
Like,
what we did is, particularly on the C-suite or some of the directors, half of either a third or a half was based upon profit. So if there was no profit, they wouldn't get that component, but they could still earn on their own basic metrics and their own performances. So we didn't want to penalize them, but we didn't want to pay all the bonuses out and there was no profit. So we would hold back a piece of it based upon profit. So, and if you were in a sales role, you had more weighted to sales. If you were in a finance role, more would be weighted to a profit. So you would still give bonuses, but not a full bonus if the profit objectives weren't met.
got it. Okay, thank you. All right, so we kind of touched on this already, so we'll go through this quick, but who is responsible? So the executives need to drive it. But as Steve has pointed out, it really can't be done in a bubble, and it requires having the other people on the team, the other departments buy in. And like we said, salespeople can sell, but if the operations people can't deliver, then those sales are really, really not doing it. And your ROI, and they just come back to the same technology company that we worked with. The ROI on the incremental marketing was creating more and more demand for their stuff, and they couldn't fill the demand because they couldn't onboard the clients. And when you get a client interested, in this case, it was a software company and they were solving all their clients' problems. Like, the client's really excited today. It takes you 4 months to bring them on. That's a problem. Now, in their case, money was the issue. It wasn't necessarily that the HR people couldn't hire. They probably didn't have enough HR people, and that was because they didn't have money. So ultimately for them, it was about raising money. But in other cases, it's about aligning expectations, and sometimes it's just about realizing that you're going to need more HR people. You're going to need more capital. You're going to need whatever, accounts receivable, financing lined up, whatever it is that you're going to need to make it all work. That's part of the budget. It all really needs to flow together. And then again, once we know who's responsible for what, you create the accountability. And back to Steve's point on the comp plans, you compensate based on that as much as possible, or at least making that a major component. All right. Next, what do we include in a budget? So there's lots of things. Here are a few. Often, typically, probably, it starts with revenue, but revenue is really a nuanced thing. So the question is, what is it that drives revenue? Right? Is it salespeople? Is it just keeping your clients? I was at an event recently, and they were talking. I was there with Ken, who's not here today, but they were talking about that there's different ways to, right? People talk about we need more revenue. We need more revenue. Well, there's getting new clients, There's selling more stuff to the same clients. They're selling the same stuff to the same clients, but changing your price, right? They're selling stuff to old clients who you used to sell to, right? Clients, customers, people who you used to sell to and kind of bring them back in. So understanding what is it that is driving your revenue? Is it the operations team, right? In some companies, it could be doing good service is what drives revenue because then you get referrals and that's great. In other situations, and maybe more product-based companies, you got to get lined up with the right stores. But even there, it could be that it's not just about selling into the store. Sometimes it's about selling into the store and then keeping them happy and knowing that you can deliver. I was speaking with someone, was at a conference yesterday. I forget if this is someone I was speaking to or he was just talking to the guy next to me, but this fellow was talking about, I think he was talking to me. Anyway, whatever. He was talking about how he's a CPG company and he sells whatever he sells, some kind of food or beverage. He's like, but you can't go into the big chains right away because then they want to order. If they like it, they want to put it in their stores and you can't expand your manufacturing that fast. So for him, it's about moving slowly, and not biting off too much, but understanding your revenue and understanding how you do it. So he's moving from single stores to small chains and eventually going to large chains, because that's how he needs to make his revenue work and that's his channel. But again, having a clear understanding of that, um, understanding what's going to drive. Are you going to have churn? Right. So this fellow understood that if he grows, he's going to have to grow a ton. So if he wants to go into the large chains, he's going to have financing, distribution, everything lined up to make that work. And so for him, smaller chains are the right solution right now. But in a service business, often you have recurring clients, but how long do clients stay for? How much churn do you expect to have? How much churn will you have? Okay. Next, what are you selling? Are you selling, right? A company can have multiple different products or services. Different things have different cost structures, right? Not all revenue is created equal. We have a client that we were talking to, and he was like, well, I'm going to grow sales at X%, 5%, 10%, whatever his number was. We, of course, asked him, why are you not growing more? And maybe we'll get into some of his answer later. But the thing is, he has different products. Some of his products have 50, 60% margin. Some products maybe have a 90% margin. How everything ripples through the company, through your budget is going to change. So understanding, what you're selling and then understanding your profit margins on what you're selling, which of those things you're selling. It's not just about the total numbers. It's not just about growing sales. It's about growing the right sales. Next, as I alluded to before, what is it that drives your revenue? So you might have a target and say, well, we're going to grow. Maybe you only have one product. You have to figure out different margins on different products. But you say, I'm going to grow this one product and I'm going to grow it a lot. Well, what is it that drives your revenue? So we had a client, they were a software company. They had two ways that they could grow revenue. Well, besides for getting more staff for onboarding, two of the other ways they grew revenue, one of those was through R&D. They improve the product, they get deeper, more people using it, et cetera, et cetera. More people inside an organization. So they were a software company that would sell in, but maybe they have one user in an organization. If they added more modules, maybe they'd have 5 users in an organization. They could charge more. But they had another option, another way, another place for their investment dollars. Instead of growing R&D or focusing on that, maybe they can do more marketing. Doing more marketing would bring in more customers. Well, what we worked out with them was that marketing would bring in customers in a certain amount of time. Their number, I think, was 6 months. R&D that they do today was going to drive revenue in 9, 12 months, let's say, because it takes time to make those things happen. It took more time for R&D, but R&D would raise the revenue on all of their clients potentially. So understanding what it is that you're using to drive your revenue and how long all that is going to take is going to tie into when exactly that revenue is going to come in with all its associated operating expenses and capital and people and whatever else it is that you need. Okay, next, there's pricing, right? If you grow sales, and we touched on this earlier, if you're going to grow sales, how are you going to grow sales, right? You can have more sales. You can potentially have more sales by charging less, right? You charge less, you become more competitive. You can have more sales by charging more sales by finding more clients. So understanding which of these things, obviously, if you lower your prices and sell more stuff, well, the salespeople might be happy, especially if they keep their same commissions and it becomes easier and easier to sell, but your profitability goes down, which probably means your cash is going down. And so in that case, how does that flow through the whole system? All right, cost of goods. We touched on this before. You got to understand what your cost of goods are. What is it costing you to produce your service? Right. And that those numbers are not always easy to find out. We had a client recently who hired us to help them analyze a transaction. They were looking to buy a staffing agency. And what they found was, well, I would call it a staffing agency, but basically like a placement agency that would send workers into a location for a day at a time, 2 days at a time, highly paid workers. And when we were digging in for this for our client, who was the buyer, we found that as the seller, as the company, the target company was growing, their cost of goods was going up on a relative basis. So let's say when they were doing 3 million a year in revenue, they were making, 60% gross margin, which means $600,000 on $1 million. So on $1 million of sales, they have 600,000. And as they were growing, that number was going down. So now maybe they were making more millions in revenue, but on every million, they were only getting 400,000. And so the question was, why? What's going on? And so they had some explanation, which our client didn't really buy. But the main thing is that understand, and their explanation, I'll tell you what it was. It was that as they took on new clients, somehow their profitability took a dip initially, and then it went up. And we looked into it, and we couldn't confirm that that was actually true. But the main point is, if that is true, you have to understand that and you have to plan for that, that your growth is going to result in lower margins, and fine, it might be worth it from a lifetime value, but understanding what that's going to do to your company. This company was having a huge cash crunch. That's why they were looking to sell or raise money. Um, and then recognizing anything else that goes in, which brings us to salaries, there's different types of salaries, right? Salaries, especially in service businesses, salaries and management salaries could be a big thing. And often, it's not just the direct labor, there's other things that really scale with direct labor. But sometimes those salaries are fixed. So understanding what that is, and when you stress test your budget, looking at which of these salaries are going to stay the same if we take a revenue hit of 20%, and which of these salaries are going to stay the same if we grow at 20%, and which ones will not. So understanding that is very, very important, because it helps you better budget and forecast. It helps you stress test. Next, balance sheet. If you run out of money, you're in trouble, right? There are businesses that we've been in and that we're talking to now where they have huge receivables lags, which means they get paid much later, right? They got to pay their people today. They get paid in 30 days, 60 days, 90 days, whatever it is. And some of these businesses are highly profitable, but if you grow too fast, you run out of money. So you need a plan. And so incorporating your balance sheet into your budget and forecasting that really, and saying, what will this look like if we do A, B, and C, right? And those businesses, if they grow slow, they might be good. If they grow too fast, they're in trouble unless they've dealt with it.
Yeah, one thing too on the balance sheet. So when you do the budget, it's good to do it, monthly as opposed to, doing a year, because when you look at the balance sheet, if you do have months where you're going to be short of cash, you could forecast, needs on a revolving line of credit. So maybe for the year you're going to be fine cash flow, but because of seasonality, there are certain months that you're going to be very tight on cash, and then you could plan and go to the bank and say, I'm going to need a revolving line of credit because on these months my receivables go up and I buy a lot of CapEx, so I'm going to need a revolving line of credit. So you can help forecast cash needs that, like I said, you may be good for the year, but because of seasonality, certain months you may need to, use a revolving line of credit. So that's one thing that would highlight.
Yeah, and we have a client who was just recently working with Steve, and Steve said, he warned them. He said, if you do A, B, and C, you're going to end up with a cash crunch. So let's start working on your line of credit. And that, I'm not going to say if they listen to us or not, but it was it's something very important to pay attention to. And hopefully now we can convince them to go out for that line of credit, because they're a highly profitable business, but because of the way their seasonality, or the way that their business runs, or fluctuations for any other reason, it, for them at least, having the line of credit is very important. Okay, CapEx. I touched on that earlier. CapEx, which, you know, CapEx maybe depends on the business, but maybe more common with technology, but not really. I mean, even, forklifts are probably a capital expense. So it's, things that you need to buy to support your business, the infrastructure that you have to build. Whether it's investing in new retail locations, investing in new technology, buying more computers, I don't know if those are capitalized, but making sure that you have what you need. And also, again, is that driving revenue? How does that, it could be driving revenue, it could just be infrastructure, understanding the difference between I guess for the technology company, it's understanding the difference between the R&D that's needed just for maintenance and the R&D that's needed for growth, and planning all those things appropriately, as well as other resources, whatever it is, people, capital, anything. You have to understand, you have to have the plan, as Steve said, especially for the first year. I mean, we've done this where we built out month to month for 5 years, but usually, the real fluctuations, the things that and can predict, are usually a little closer, let's say for the next year out, or 18 months, and really coming up with that plan and recognizing what it is that you're going to need so that you don't get yourself in trouble. All right. Any questions or comments at this point? All right. Next.
Garrison.
Yes.
Okay, very, very informative. Thank you so much. One point I want to ask is, you mentioned about a lull sometimes when bringing in new customers or revenue. There's like a little lull, and then it'll pick up even in a profitable company. So what I'm wondering is like two things. Number one, companies have sunk costs, or maybe call it complementary products, where the customers will only purchase a higher revenue item if they also purchase something that you may even be losing by selling to them,
Right.
or breaking even. I wanted to hear your thoughts on that, if it's possible. And also, the rule of thumb, I guess, that used to be out there 10 years ago on marketing and ROMIs, on like what is discretionary and what should a company anticipate on that marketing line item. I'm wondering what your thoughts
are. Well, I'll start with sunk costs. I mean, is your question more about sunk costs or more about like lost leaders? On the first question.
I'm not sure about what you said about lost leaders, but I'm just feeding off your comment that there could be a lull, and there could be a moment when you're growing too fast and you're taking on customers or selling certain items that the company has to expect they're just
watch out,
sinking,
vehicle on shoulder ahead,
for the time being, so that they could continue to operate well.
What's the question? What's the question? I mean, sometimes that happens.
Right, exactly. So when do you tell your clients that, okay, just be aware of it, that it doesn't extend too long, or what should a company anticipate when they do have complementary products that are break even or sunk cost? What's the norm?
I mean,
continue straight for 14 minutes to exit 4 I-95 Cross Bronx Expressway.
Okay. I'm not sure I understand the question. Steve, do you understand?
No, I'm trying to follow it. I'm having a hard time.
Basically, there's times when there's a lull, not because
Right,
the company is not profitable. The company is very profitable,
right,
right? But not every item, and not you know, are they going to be 2, 3, 4x of margins of what they're selling?
right.
When do you alert the customers, the clients, and say,
Oh,
how do we gauge that you're not stepping too far down, you're dipping too much because of the complementary products or the sunk cost?
oh, okay. So I mean, I'll tell you how I look at it. And Steve or anyone else can jump in as well. The way I look at it is you have different products. Sometimes some products are more profitable, some products are less profitable. Every product has some kind of contribution, hopefully. And unless it's a loss leader, and then you really need to pair the loss leader with wherever the real contribution is. So it's about understanding what is that contribution, and then you forecast your different revenue lines with your different contribution. So we have had clients where there were some things that were higher profit and some things that were lower profit, and you just break it out and you're forecasting the different things with everything that again with their contribution. Now, right, if you have a product which is, but ultimately you need the contribution from the number of units from each respective product or service line, whatever it is, that all needs to cover your overhead. And then
Yeah.
what's left after that is profit. So if your revenue forecast is to only grow this line of business, which has, like 5% margins and all the rich stuff you're not growing, that's a problem because we just look at the plan and say, like, you got to sell, 3 million of this to even break even. And by the time you sell 3 million, you're going to need more salespeople. The whole business, more salespeople, more overhead. The whole business doesn't work. Now, if the plan was to sell the higher margin stuff and some of this lower margin stuff, and then that wasn't working, then that's kind of where we're up to. That's the next thing. It's important to reforecast and say, well, what was the plan and what changed?
Very good, very good. Okay, appreciate it.
That's how I would approach it.
Yeah,
And
when you
then,
have different product lines that have different profits, you have to get more granular in the forecast. You can't just say, all right, instead of doing 5 million this month, we're going to grow it to 6 million. Well, what is in that revenue? If it's, different margin business, you have to really forecast how much of each you're going to sell. You do your best guess. You're not going to hit 100%, but because you could really get screwed up if you forecast that all my high margin product's going to sell, and then you end up selling the low margin product, then your profit's not there. That's going to be a problem. So I think you do have certain products that have different margins, and you have to try to forecast as best you can not how much you're going to sell, but of what product set you're going to sell. If there's a difference in margins on each of the product sets.
Very good, very good. Appreciate it.
and I
Now, I don't know if you're touching marketing now or it's out of context. I was wondering, like, is there a rule of thumb these days on when it's overdoing it and when you got to do more?
don't have a rule of thumb. For us, it's really about talking to the client and understanding what it is that we're not starting the business from scratch. They have data, they have experience. But we had a technology company where they said the goal of their marketing was, and this is not really a technology point, but we know we have clients in technology, home care, retail. We have a client that loads and unloads ships on a river in the Midwest. But with this particular client, they said that the goal of their marketing was that if their clients saw them 7 times, then they would just, when they got like formally introduced, they would like close the sale in 1 or 2 meetings. And if not, they would just have to go back and meet the client 10 times. So for them, the idea of marketing was it shortened their sales process. For other people, maybe marketing is, I don't know, maybe it's to repel the bad client so that it saves you time. You don't waste time on those kind of sales calls. Different people have different, some people marketing is almost like converts things into sales really quickly. And there's different types of marketing, and at least for me, I'll let Steve jump in a second, but for every different business, just different, it's different.
Yeah, the thing on marketing is one of the toughest things to budget. Not so much budget the amount, but what does the effect of marketing have to do upon sales? We had always battled. Marketing always wanted more money. And then we would say, well, prove that the marketing you're doing is bringing in incremental sales. So it was always a battle between marketing. They want to spend more, and we'd say, no, spend less, because it's very difficult to try to quantify. At least we found in the business I was in, direct marketing on the internet. Maybe you could gauge the number of hits if you do some SEO searches, but it's sometimes very difficult to find out, the cost benefit on marketing. I would always say undershoot the marketing, because they're going to want to spend more, and you don't always know if you're getting the bang for the buck. That's just from my CFO perspective. Somebody in sales is going to say totally different, that the more you spend on marketing, the more sales you get. But I never always saw the correlation.
Thank you. And thank you, Ezra, for your question. All right, so let's talk about reforecasting real quick, and then we're gonna wind it down after that. And this is really in some ways a recap of some of the other things we've discussed, but right, the plan, everyone needs to have the plan, needs to be on the same page as the plan, as each other, really. And then so different departments are going to be responsible for different things, right? Sales are responsible for that. If the sales aren't coming in, then we got to go back and say, why is that? But if the sales are coming in, they're not, we're losing clients, that may not be on the sales team, right? You're going to have lower sales, but that's because we're losing clients. So it goes back to, you really need to have the metrics, know what it is that you're looking at. You need to be able to get them quickly. I mean, we had a client, it was actually a nonprofit, but it's neither here nor there. They had their bookkeeping, and it took a certain amount of time to get things closed and to get what they needed. And there were certain metrics which they needed to have, and they needed to have in real time and quickly. We built them a custom tool where they were able to pull their information from whatever system, and very quickly, within a matter of minutes, they could get exactly what they needed on certain metrics. Because for those things, it took too long to get it the traditional way. But the main thing is you have to understand what you need. You have to be able to get those things, get them quickly. And then that really allows you to adapt and say, okay, well, with this client, the nonprofit, right? Pledges are coming in, like people are pledging money, but collections has dipped. Well, why has collections dipped? And then you go and you address that quickly. Is it because the economy, or is it because, someone took off for a month, or we lost that person in that department, and, it's fallen to the back burner. So what changed? Why did it change? I mean, I was at one of my first jobs out of graduate school, really, was I was working at a large government. We were running a $3 billion budget. And I remember sitting in a meeting with the CFO there, and comes in, he's holding 2 cash flow forecasts. And he's like, there's $100 million delta between last month and this month. What's going on? Right. But where we're going to end off the year. And it turned out, some issue with whoever had come up with the projection, but trying to understand, getting that accurate, timely reporting to measure the actuals. Again, there's also the reforecasting, but getting the actuals, getting the right information, understanding what to look for, and then asking the right questions. And yeah, and sometimes you need external resources to help with these things. Sometimes you can use external resources to build the process. Sometimes you do it on your own. But yeah, you gotta reforecast based on the changes, based on reality. Your margins didn't come in. Sometimes there's some issue that you can correct. But sometimes you have to reimagine the business because for whatever reason, things aren't selling. You used to sell units at 400 a unit. Now you're selling at 300. Just lost $100 of margin, which could be half your margin. So what are you going to do now? What does that mean? How do we have, so these things all, but again, having the process and having the forecast and having the accurate data, budget of the forecast and the accurate data will then enable you to go notice the changes, either fix the things that need to be fixed, change what needs to be changed to adapt to the new reality. And yeah, that's the end of my that's the end of the budget thing for today. Anyone have any questions, comments? Anyone else on our Steve or anyone else on our team want to jump in and add something? If not, I'll take a minute to talk about different types of budgets. So you can make a budget by looking at last year and saying, okay, well, here's what it was last year. I think we're going to grow sales, but we've already discussed how, certain aspects of that are problematic. Certain things maybe you could do. But there's a whole other approach, and that's called zero-based budgeting. So it's basically ignoring last year. And perhaps there's elements of both of these that are worth incorporating. Not everything always needs to be fully rehashed from scratch, but it's an approach where you go in and you say, listen, I don't know what happened last year. Let's just start off this year. Let's look at the CEO's salary. Should a CEO really be making that much? Or what should a CEO make? Right? What should rent for a company like ours look like, as opposed to, well, here's what it was last year, it'll probably go up 3%. And if you look at this and you say, you know what, rent shouldn't be more than 10% of our annual expenses, and it's 20%, then you don't look at that and say, okay, well, it's 20% plus 3% growth. Next year it'll be like 20.5 or whatever. You say, maybe we need to go find a new place to rent, or maybe we need to cancel our fax machine subscriptions, right? So, right, if you don't look at this from the perspective of why do I need this, and you just look at it and say, well, here's what it was last year, here's how we're growing, here's what it'll be this year, then everyone would still have fax machines. And there would be no cell phones. Or maybe there would be cell phones and fax machines. But anyway, the idea is zero-based budgeting. You're really taking a critical eye and looking at that, looking at each individual thing and saying, is there a reason for this? What is the reason that we need each of these things? And it's really starting from scratch and not necessarily basing it on last year and, growth or change. And it's more intensive, and it's definitely a valuable way to look at things, many things. All right. Steve, anything else to add?
No, and one of the things that, not to make this commercial, but like one of my clients, I didn't do the budget for him because, he didn't really want to pay me to do the budget. I get that. But I was able to review, in a couple hours, look at stuff, said this doesn't make sense. So have another set of eyes looking at it. So we could actually do that. If you're preparing a budget, we could help just, look at it and see if there's any things that we catch that don't make any sense. Because sometimes you're in the weeds with it and you just don't see something and have an outsider say this doesn't make any sense. So that's all I wanted to add.
Excellent. Well, as a commercial, listen to what Steve said. Definitely should have someone taking a look at your budget and stress testing your stuff. And yeah, that's where a CFO comes in, and we, if there's any way that we can be helpful, reach out. What I always tell people is if we can solve all your problems in half an hour, you probably weren't going to be a very big client for us. But if not, hopefully we get to know you in that half hour and then can help you more afterwards. Anyway, Brittany, do we have a questionnaire for today?
No, we don't. I apologize.
All right. If anybody wants to learn more about budgets, if anyone wants the presentation, if anyone has any questions, please reach out to us. We will be sending out the video as well once it's up on YouTube. And if anybody knows anyone who needs our help, please send them to us. We'd love to help them. Thank you to all our guests. Thank you to all of our teammates who joined. Thank you, Jim. I see your face now. Thank you. Good to see you. Thank you, Ezra. Thank you for your questions. And thank you, Brittany, for setting this all up, as always. as always.